might be too early to say I told you so, but this month has been the most opportune month out of the entire year to buy stocks. And surprisingly, the Canadian markets have now been outpacing most global markets, including the United States. I mean, look at the returns. The banking sector is up double digits this month. Actually, I don't think you can find really one severe stock in the entire Canadian sector. I mean, yeah, things have been changing on a week by week, but earnings have been incredibly strong to start the season. Heck, we've seen the most suppressed stocks like Bell start to rally back. We've seen Telus that we're going to be talking about in this video. The energy sector on the back of oil doing so substantially bad. We're seeing a recovery now, especially in stocks in like Canadian Natural Resources. CNR, I mean, you throw a dart, you couldn't have done any wrong this month, which is why it's so prudent to cost average. And I love reading the comments because, yeah, Google is still kind of one of these speculative stocks on the future of what's going on in the realm of AI and if it can completely deteriorate their search business and what the value is. And I mean, there's risk with that, right? But even if Google dropped in half, it's not going to materially destroy my portfolio when most of my money sits within indexes that have now propelled my portfolio to all-time highs, right? Now, not on a percentage basis, but from cost averaging in these periods of a suppressed market, when you start getting these 10% bumps after throwing tens thousands in the market, all my stock market emergency fund, man, we're seeing some real returns. We're almost at 400,000, which I didn't think I'd be here this quick. And I've been making bets with people that we'd actually finish flat or to the downside on the S&P 500 because earnings, we're starting to get a little bit of a bump on some stocks. We're still seeing impressive earnings, but there's still a lot of concern on the lower half of the market when it comes to consumer spending, GDP growth, all that stuff, right? So it's kind of like always a mixed bag, but regardless about how I feel and where I think the markets are going to be, I always be buying, baby. I like debating both sides of the coin, the depressive side, the recession side, but I also like spouting the bullish side and the keep buying side and live in that realm of glass half full optimism. I have built my wealth in the realm of optimism because bears always get sent to slaughter over long periods of time. And I was able to buy a condo here in Toronto during this period down here when the market absolutely got slaughtered. This is where most of my wealth was really made, was in 2020, because I did a thing a lot of investors didn't want to do, and that was go really aggressive, right? But VDY on the Canadian side of the border is outpacing the U.S. markets right now. Actually, the Canadian markets as a whole are outpacing the U.S. markets. Over the last year, we're up 11.5 or 11.15%. The U.S. markets up only 8.5%. Even on the year to date, the U.S. markets are still down 3%. And the Canadian markets are actually now flatter, especially with VDY. I think VCE is actually up more than this, the Canadian ETF that's more comparable to VOO. But what I really want to talk about is these telecom giants. As many of you know, I sold at a Telus, and that's because I've been telling you guys you can concentrate your portfolio in periods where the market's down, but some stocks you've been holding have actually been holding up better. And we bought Telus at a great price. I mean, we bought it, I think, somewhere at that $21 range. When it tanked, and then basically the whole markets went into this crazy cyclical down period where I was like, I can't help myself. I'm seeing a bigger discount in the broader markets than I am perhaps with Telus. I'd really like to buy some S&P. I had like $5,000 in Telus. I sold it, and I bought the S&P somewhere down in these lows here, and I'm seeing quite substantial returns. But still, Telus might have this capability of even outperforming the S&P in many markets right now because I think it's trading considerably cheap. And here we are actually seeing the bottoms actualize as Telus begins to perform here. I mean, it's the best performing telecom giant. It's been my favorite telecom giant regardless, and I'm glad I do get some of that exposure through VDY. Again, not a materially huge exposure, but nonetheless, this is one of those telecoms where as Bell cut, this one's raising its dividend. And we should talk about it because over the last 10 years, from 20 cents to 40 cents, we're talking about a doubling of the dividend. The dividend scorecard, if we take a look here, the growth rate has been 9.63% over the last 5 years. Payout ratio is pretty high, I think, through dilution. We've talked about how they're paying the dividend. I think they do a lot of depreciation, amortization costs. You have to keep in mind they are, still diluting a lot of these telecom giants continue to dilute to build that infrastructure, which I'm fine with to some extent. It's just how they're using it, which I think Bell was using it inappropriately. So they actually decided to cut the dividend and the dividend reinvestment plan. But Telus is like, hey, we don't have to do it. And when you read through their news articles, this company's trying to really pump up the AI as they launched a sovereign AI factory here in Canada, like I think the first one. I mean, every other article is Canada AI leader, AI, oh, another AI. They're launching some, crazy AI stuff and being a leader. It's just like they're using the headlines like every other company is right now to try and take advantage. I don't know how much it's actually exceptionalizing their earnings. I don't think it has much to do with their earnings at this point, but nonetheless, they are still the best growth vehicle in the telecom sector. As industry-leading text total mobile and fixed customer growth has been 218,000, up 9,000 over last year. And if we read on, including new Telus Health reportable segment and operating revenue and adjusted EBITDA growth of 3 to 4% respectively, and reflecting the economic resilience of our business within a dynamic operating environment. Consolidated free cash flow up 22% and cash from operations higher by 13%. As mentioned, I told you guys, I think we're in the bottoming cycle because these companies went through massive layoffs, restructuring costs, higher interest rate environments, and all of that is basically behind them at this point. The consistent with dividend growth program with quarterly dividend raised by 0.4163, an increase of 7% over the same time last year, representing a yield of approximately 8%, which they're seeming to tout, which I think is what's driving a lot of investors to the stock right now. And let's kind of dive into the earnings a little bit more in depth to get a full view of comparable performance. Year over year, they are up 3% on the revenue side, but we're going to take a look at the quarterly growth and comparable just to take a quarter over quarter representation of this. What I do like is this segment, which I think is a superior segment to Bell and Rogers media segments because they have health, right? Like they're focusing on telehealth, which seems to actually be a massive growth driver at 7% for them, getting 76.5 million healthcare lives covered, which is kind of incredible, really. Total telecom subscribers connected continues to grow at 6%, which is quite incredible on the back of an economy that isn't doing much immigration at this point. So let's just zoom in a little bit farther here and take a look at total operating revenues here on a quarter over quarter basis, because we can see this is where they did about 5 billion. In Q4 of 2024, they did 5.3, and Q3 was just over 5, which was actually better than where we sit at Q1. But overall, from Q2 of 2024, Q4 2023, they were actually doing materially better. And I'm trying to show you this to give you an example. I don't like when they look on an annual basis back, because in totality here, the revenues have been mostly flat for, the exception of Q4 of 2024, where they got a nice revenue bump. But in totality, there's not like a huge amount of growth going on. So I do want to keep that in mind. But what I mentioned is the actualizing and the return of net income. Because we can see net income here sitting at 301 million, which is actually starting to recover from the insane lows of 140 million in Q1 of 2024. And if we actually take a look at their interest expense, and this is something that they actually, they kind of point toward, because if you take a look at interest expense sitting at 349 million, is basically flatlined, which is good because this has been going up quite materially. And you can say financing costs decreased by 50 million in the first quarter of 2025, mainly due to the following factors. Interest expense increased by only 1 million in the first quarter of 2025, largely as a result of a decrease of 11 million in gross interest expense on long-term debt, excluding lease liabilities and other in the first quarter of 2025. This was primarily driven by a decrease in effective interest rates of average long-term debt. We are actually seeing an impact of debt going down. This is what I've been telling you guys. This is the bullish factor to the company. Interest rate recovery play. And I still think you're in a good place to be buying this stock. It hasn't really done much. It went to 22. Whoop-de-doo. It went from 19 to 22, maybe 10 to 20% movements here. But when you zoom out on that 5-year chart, we are still trading in the relative toilets for these companies. They've got a long way to go in their recovery. So, if you want to own them as a segment, I don't think they're that bad, but I've always said that Telus is probably the superior one to own. But I can't help but think we're starting to see bottoms in the entirety of this sector, especially with the cut that Bell recently did. Rogers posted quite reasonable earnings. So I think we're sitting in a place of now relative strength where the buying opportunity is probably there for most of these companies. Overall, though, the markets are sitting in a hyper peculiar place. We've been sitting flat, still seeing some upper trending to the broader markets in the US. It's full on risk still, which is showing that the markets are incredibly strong, with Bitcoin rallying over 102,000 here, which is quite incredible. Tesla's been catching a bid, trading around the $300 price mark even after horrendous earnings. So overall, we're moving back in again into a buyer's market, a greedy market to say the least. And these aren't markets to be necessarily excited about. This is why I've been focusing on rebuilding my cash positions, focusing on paying down the mortgage again. With things starting to recover back to, yearly levels where we started the year. Like I said, guys, when you got those massive discounts and I was screaming to you, buy, I hope you bought. Not from financial advice. I'm not a financial advisor. It's just my own personal opinions here. Of course, I'm a clown on the internet, like many of them out there, but I always seem to outperform. And a lot of that outperformance comes from just buying the dips. But I'd love to know what you think in that comment section below.